Ladies and gentlemen, welcome back. Welcome back. I hope you've had a wonderful lunch, and if you're worried about the post-lunch slump, don't. Our next panel will make sure that's not going to happen. Over the past 30 years, the world economy has experienced multiple shocks. The Asian financial crisis of 1997-98, the global financial crisis of 2008-09, and of course the global pandemic just a few years ago and its aftermath. Central banks, alongside other authorities, have adapted and adjusted their policy tools to cope with these challenges, including reviewing and updating their mandates. But we're in an increasingly uncertain world where inflation is likely to stay higher for longer. Technologies are shaping the financial and economic landscape in very fundamental ways, and international cooperation is increasingly under pressure. How can we draw wisdom from the past to better prepare for the future? These are big questions, and we expect our panel will have some big answers. So please welcome our moderator, Mr. Joseph Yam, non-official member, Executive Council, and former Chief Executive, Hong Kong Monetary Authority, and all our panelists. They are Dr. Zeti Aziz, founding chair, Asia School of Business, and former governor, Bank Negara, Malaysia. Jacob Frenkel, Chairman Emeritus, Group of 30, and former Governor, Bank of Israel. Philip Hildebrand, Vice Chairman, BlackRock, and former Chairman, Governing Board of Swiss National Bank. Philip Lowe, former Governor, Reserve Bank of Australia. And Masaaki Shirakawa, Distinguished Guest Professor, Aoyama Gaoken University, and former Governor, Bank of Japan. Please give them all a warm welcome.
Shall we start? First of all, actually, a happy birth year to the HKMA and to the BIS Asian office. Now, I'm a person who is in the position to say that because I started the HKMA, and I started, well, with the help of the BIS, started the BIS Asian office here 25 years ago. And in saying that, I have to thank one person up there, who is Andrew Crockett. He actually was the... I miss him. He actually was the midwife delivering the HKMA. And I lobbied him to set up an BIS Asian office here in Hong Kong. So thank you very much, Andrew. Miss you. And thank you very much, Augustine and Eddie, for inviting us. We are really a bunch of geriatric central bank governors. But we're determined to have a bit of fun, actually. Well, now, obviously, we are happy to share our long past experience in central banking to see if we can help our successors, some of whom we actually groomed over the years, and to see whether we can help meet the challenges, the many challenges they face. Now, since we are all retired, we have no responsibility, we can talk freely, and we don't need any steering, but we do need a bit of introduction. And I will start from the far left, Shirakawa-san, Bank of Japan, Governor Bank of Japan, from 2008 to 2013. He had 4 decades in the Bank of Japan. He was also vice chairman of BIS board for 3 years, and currently he is distinguished guest professor at Aoyama Gaoken University in Tokyo. Next is Philip Lowe, who just finished his term as governor at the RBA, Reserve Bank of Australia, 2 months ago, after another 40 years service at the bank. He also served as the chair of the BIS Committee on Global Financial Stability, what we call the CGFS, between June 2018 and September 2023. And then another Philip. Hildebrand. Joined the governing board of the Swiss National Bank in 2003, became vice chairman in charge of financial stability in 2007, and then chairman from 2010 to 2012. During his time, Philip was also appointed vice chairman of the Financial Stability Board. Expert in financial stability. Currently, Philip is vice chairman of BlackRock. Now, Jacob needs really no introduction for us veterans, but he was governor of Bank of Israel during 1991 to 2000. And during 87 to 91, he was the economic counselor and director of research of the IMF and served as chairman of the Group of 30, a very prestigious group during 2001 to 2022, over 20 years of chairmanship there. He held top positions in a number of private institutions, including Merrill Lynch and J.P. Morgan. Now, last but not least, Dr. Sethi, my dear friend. We were born in the same year. We both had 16 years as governor of a central banking institution. We lived through the two crises, the Asian financial crisis and what they call the global financial crisis. She's currently the founding chair of Asia School of Business in Malaysia. So that's the introduction. Let's get on to business. Now, I understand from Augustine that this morning the sentiment was that perhaps you have done a great job in lowering inflation and not causing too much concern in financial stability while maintaining a low unemployment rate. Very good score there, But circumstances are different from what we have experienced before. Now it's also complicated by geopolitics as well as the advancement of technology. Now, Jakob, I want to start with you. Now, he's the person, you better be careful, because he is famous for being able to give you an insightful soundbite that you will remember for the rest of your life. I can still remember one. No bank is too big to fail, and no bank is too small to be bothered with. That's from him. Jakob, what do you think about, the efforts of our successors in bringing down inflation? Have they done enough? In various jurisdictions, inflations are actually still pretty high, and interest rates are still negative. What do you think?
Thank you very much, and I'm really delighted to be here. I've never been introduced as the head of the geriatric department, so I will take you to the infancy. I was for many years a professor at the University of Chicago, and I stopped teaching because I did not want to be bothered with giving so many grades. And now at this stage of my life, you ask me to grade my colleagues and former colleagues. But I can tell you, in the past, central banking was much simpler. In the 30s, there was a classic book by Ralph Hawtrey, the title of which was The Art of Central Banking. And those of you who will go to look at it will not recognize what you are doing now with the title of central banking. Maybe because it is the art, and art is not science, and we occasionally think that we are scientific, so we need to be careful about it. But you asked me about has central banking changed dramatically, and about inflation and all the rest. The fact is that if you look at the age distribution of governors and of young people, now young entrepreneurs, until very recently, you will think that inflation is part of the dinosaurs era. And inflation is like smallpox. It's been evaporated. And that's why there is a danger in it, because if you never experienced inflation, maybe you don't take the guards against inflation. We are now in a phase in which inflation has burst, and it has surprised many of the central bankers all over the world, not, of course, you, because you knew it all in advance. But the fact is that central banking in the past was much simpler. You knew you have to achieve price stability, and occasionally, if you were in college in the wrong years, you thought that there might be a trade-off called Phillips curve, but by and large, it was relatively simple. And then suddenly, crises came one after the other. And when you look at all of these crises, you see that they all primarily have had the same origin, financial markets. And if it is financial markets, you will never hear the word financial markets in the Ralph Hawtrey book, or if essentially in the first generation of central banking. And those of us who have been long enough there and coming to the BIS meetings will recall that it was the BIS, actually, that brought it to the fore with a lot of objections by the leading central bankers at the time. And so I think that it is worth recalling, and not only recalling, but also recognizing and acknowledging the extraordinary contribution that the BIS has made to bring us to where we are in the analytical framework. Having said this, and we have here people who are either have been or are in the FSB and all of those things that are now occupying central banking, we still have to ask ourselves, how come inflation surprised us? After all, in many of the crises that we have had more recently, not only the financial crisis, but also the real crisis, we have flooded the markets with a lot of liquidity for maybe good reasons, but we should not have been surprised with the outcome. After all, this money did not go to the moon. It went to some places. So where will it go? It went to the financial markets. Why did they go to the financial markets? Because interest rates were so low. And it exploded, and therefore suddenly it looked like you are having prosperity as measured by financial markets, and the disconnect between real and financial economies became apparent, and it was clear that since financial markets at the end of the day must mirror the real economy, the numerator and the denominator, those things will need to come together one time. And they came together. So we should not have been surprised. So why did we waste so much time in asking whether the burst of inflation is transitory or permanent before we actually dealt with it? And the reason is really conceptual. The conceptual one is, do you look at the rear view mirror when you drive, or do you look through the front? It doesn't matter whether you look through the rear view or the front window if the road is very straight. And if it's straight, you will never get into an accident, whatever way you look at the road. But if the road turns around, then looking at driving by the rear view, you know that you are going to be having an accident. And the question was, therefore, are the shocks permanent or transitory? I think it's the wrong way to pose the question. Because the role of a central banker is to ensure that those shocks that come to the system, that upset price stability or financial stability, become temporary because of the actions that the central bank will take. And since everyone will know that the central bank will be courageous enough and will have the legal independence to execute his belief, all shocks will become temporary. And if they become permanent, then it means that you failed. So rather than waiting to see if it was permanent or transitory, which is the recipe of falling behind the curve, by definition, the issue of forward-looking is important. And that's where the more recent crisis has led us, in a way, astray, because models failed. Models failed because they were built on the past record, like most models are. But if the roads turn around and the past is in fact, excess luggage rather than an advantage. That's where the analytical perspective needs to be developed and a concept. So central banking indeed has changed dramatically, and some of it is because the world has changed. Some of it is because we have had new shocks. We have never had to deal simultaneously with the financial shocks and then the real shock, then pandemic, then war. That has price implication, and we confuse them ourselves whether supply shocks need to be accommodated or fought. All of those things were in the background that make the life of central banking very different than the one that Ralph Hawtrey had in mind when he wrote The Art of Central Banking. But still, it means that economic analysis and foundations are the key rather than just time series analysis when you have unstable structure. Let me stop here.
Thank you very much, Jacob. Let me move on to Shiragawa-san, because he's experienced, under his watch, inflation in Japan has been low, and now you are seeing an uptake of inflation. We don't know whether that is transitory or permanent, as Jacob pointed out. But we know that it is something that you wanted, actually. And we were wondering whether or not, the lack of action recently in actually dealing with the increase in inflation, which is now up to 3.5% or whatever level. What sort of considerations were behind this sort of delay in action?
Okay. First of all, when I was a governor, the discussion was always about low inflation or deflation. And Bank of Japan was often criticized by not being aggressive enough. And many industrial countries are citing Japanese experience of showing the period of deflation. Look at Japan. So we have to make every effort at avoiding Japanese style of deflation or low inflation. That was up until 3 years ago. Now many countries are coping with how to contain inflation, and situation has changed. And many reasons are cited. But one of the important causes for high inflation is, I would say, the failure of intellectual model, which many economists and policymakers were adopting. So in that spirit, I'd like to talk about Japanese low inflation or deflation experience. Yes, Japan recorded the low inflation or deflation. And at the same time, Japan recorded low growth, which was in sharp contrast to the remarkable success in 1980. So in that sense, it is natural for people to think that low inflation or deflation is very dangerous. But I'm very skeptical about this kind of argument. And we have to look at the fact without preconception. Between 2000 and 2012, which price level ceased to decline, the GDP growth rate among G7 countries, Japan's growth rate is the lowest among G7 countries. But if we look at growth rate of GDP per working age population, Japan is the highest among G7 countries, which is much higher than that of United States. And during this period, working age population declined by as much as 15%. 15%. This is a huge headwind. And this loss of GDP cannot be solved by aggressive monetary easing as such. The fundamental issue is how to cope with declining population and how to boost productivity. That is a real issue. But nonetheless, many people flirted with the idea of how to boost inflation. And unfortunately, for instance, some countries adopted average inflation targeting. Japanese experience was used as a, as a justification for adopting average inflation targeting. And so one of the lessons which other countries should draw from Japanese experience is you should not be overly concerned about low inflation or deflation as such, unless financial system stability is maintained. And so, in that sense, deflation in 1930s is quite different from very mild deflation in Japan, and that is one lesson. And today, Japan is seeing some increase in inflation. And by Japanese standard, this is very high inflation, although this is somewhat lower than that in other countries. And nowadays, economists tend to view the rise in inflation as a possible sign for change in Japanese revival of the economy. But I dislike this kind of argument. And as I said, low inflation or a slightly higher inflation is nothing to do with fundamental issues like population change, demographic change, or productivity increase. So what I'd like to emphasize is productivity, not flat with the idea of deflation. And so that is my take on Japanese inflation and the possible implication for other countries.
Thank you, Shiragawa-san. When looking at the inflationary situation, I think that central banks are doing a good job in lowering them without affecting significantly financial stability. But I don't think that the job is done yet. And I also do not think that the high for long interest rate scenario has yet fed through to totally to financial markets, and there may be dislocations of one sort or another that we have not yet seen or experienced. At which point I would actually like to turn on to the financial stability issue. Dr. Sethi, you have handled the two crises, the Asian financial crisis and the global financial crisis, very successfully. And each time, Bank Negara and Malaysia come out stronger. You must have a secret. Now, I would like to ask you whether how you see the current situation. Is the next one around the corner? Is the next one coming? What advice do you have for our central banking colleagues as to how such a situation should be handled?
Well, first of all, let me first congratulate the Hong Kong Monetary Authority on the occasion of their 30th anniversary, and to the BIS Hong Kong office on their 25th anniversary. And I should say that it's perhaps fortuitous that I'm on this panel today and moderated by Joseph Yam, because almost 15 years ago, when Bank Negara Malaysia celebrated our 50th anniversary, and that was about 15 years ago, that was attended by 50 governors. And Joseph Yam was our first speaker to commence our celebrations. So I'm delighted to be here today on this panel. Now, probably the biggest lesson for us after we experienced the Asian financial crisis was we needed to build our resilience. And that is how we've survived from East Asia in particular, affected by so many developments since then, which is about 25 years ago. Time and again, we've survived, not to say unscathed, we were affected, but we didn't land into a crisis situation. And this was by building resilience. And we did it in several ways, but for us in the emerging economies in particular was diversifying our financial system. That was very important so that it's not bank-centric, where all the risks are concentrated on the banking system. We developed our capital markets, and what is important in developing our markets and talking about markets where many of the crises originate from, is correct. And you also need to develop the players. And when you develop the bond market, for example, you need the insurance sector, the pension funds, the asset managers, and so on, so that they are institutional investors in these markets. And so I read a report once, the BIS report, before your time, Augustus, that it said that 40% of the bondholders in our market in Malaysia was held, the papers were held by non-residents. And with the taper tantrum, there'll be an exodus from the market, and there will cause the risk of a collapse of the market. But that didn't prove to be correct, because when there was a sell-off, indeed, when there were massive outflows and there was a sell-off, the domestic institutional investors stepped in. So the yields actually didn't move as much as what was predicted. And so this is important in part of building the resilience. But let me come to the more recent development relating to interest rates. Now, in relation to this, I wish to highlight two things. That there's already an international consensus regarding the management of the 2008-09 crisis. And I should mention, and I did mention to Joseph, that we shouldn't call it a global financial crisis, the GFC, because Asia Pacific and many parts of Latin America didn't experience, we were affected, but we didn't experience a crisis. And therefore, well, if you want to keep the acronym of GFC, it can be the Great Financial Crisis.
We did have to do something to defend ourselves, though, in 2008.
Yes, we did, but we were relatively more resilient. And I'm not saying that we weren't affected. We were affected, but we didn't. Our financial intermediation continued to function, and we progressed and recovered from it quite quickly. And we had growth recovery, unlike the low interest rate. But during that period, after that period, there's already a general international consensus that there was an over-reliance on monetary policy and that interest rates were too low for too long. And also, for the current inflationary conditions, and this is something that Jacob raised already, that there was also a delay in the policy response to normalize and to tighten interest rates. And this has prompted, because of the delay, it has prompted the need for a more pronounced adjustment in the interest rates. Now, during the 2008-09 crisis, the emerging market economies did not bring interest rates to those all-time lows. And in the current period of inflationary conditions, many emerging economies had started to raise interest rates much earlier. And when I talked to those from Latin America, they said, well, before it was recognized, they had already started to raise rates. So for these two reasons, emerging market economies should not be expected to shadow the interest rate movements of the advanced economies. And there should be a decoupling of the extent of interest rate movements in the advanced economies and the emerging economies. That's very important because, and then moreover, many emerging economies have had a track record of successfully managing bouts of inflationary conditions in their economy. So given this, there should be a recognition of these differences, which would then should not produce an overreaction in the markets to produce an over-adjustment in the exchange rates, foreign exchange markets, and also and also on the impact on potential growth and development in the emerging world. Thank you.
Oh, thank you very much. You didn't answer my question. One of my questions is the next one around the corner?
Well, I would say that we need to anticipate that it will be around the corner and be in a state of readiness. And if it is around the corner, and if we are in a state of readiness, it will be short-lived.
Thank you very much, Dr. Sethi. Philip Hildebrand, I would like to ask you the same question, actually, given that you've been, well, instrumental in introducing quite a lot of post-crisis reform to the financial system, being vice chair of the Financial Stability Board. Yet, you are now also in the private sector in BlackRock. You obviously would look at market developments. And like me, I'm sure you noticed some dislocation in the debt market, the US Treasury market, for example. And those are signs that to us here in this part of the world are actually quite worrying. Now, what do you think? Is the next one around the corner? Or have we done enough to stop history from repeating itself?
Thank you, Joseph, and thank you for having me. Eddie, it's wonderful to be here. I remember coming to Hong Kong when the BIS office, I think, had about 5 people, maybe, at the beginning of my tenure at the SNB, so it's wonderful to see what's happened here. It's also testimony to the long-term thinking of central banking that we haven't aged at all of us up here. So. Look, I think what is around the corner, Joseph, is that the world has really changed quite fundamentally, and we should, as we think about banking, crises, financial markets, we need to put that in the context of how the global economy has changed. And I think the key change is not so much that we had the spike of high inflation that we're going to get back under control, but it's really the supply side of the global economy. We are facing significant constraints on the production potential of the global economy that will likely be around for a persistent period of time. This means the inflation dynamic, irrespective of whether we reach the 2% or not, are going to be quite different. During the Great Moderation, I think nobody saw this more clearly than Mario Draghi in a way. He realized that the production potential of the global economy kept expanding for various structural reasons linked to globalization, to China, and many other things. And as a result, he understood that no matter how much demand you had, you really wouldn't get inflation. And I think that's the kind of underlying macro story, in a sense, of the Great Moderation. As we have now shifted to a very different world, where we have constraints around fragmentation, geopolitics, the transition to net zero, trade that is being constrained, aging, of course, as a very important structural factor, we are facing, I believe, significant supply-side constraints. This means that we're going to constantly kind of bump up against sticky inflation, even when we get to 2%. And I have no doubt that we will reach these targets again. but the underlying dynamic is going to be quite different. For decades, we basically had a structural bias towards easy policy. Now, I believe we're in for a long period, perhaps a very long period, of a kind of structural bias towards tightening policy. This changes the way financial markets behave, this changes the way banks behave, and you can see this quite clearly in the contraction of bank deposits that we're seeing in the context of the change in monetary policy and the very aggressive change in interest rates. So a lot of money is shifting away from banks into capital markets. Now, in many ways, this is good for savers, it's good for capital markets, it's good for BlackRock. But I think it does mean we have a different dynamic around banking. Banking is going to get more expensive. Banks have to compete for deposits when you get paid 5% interest on cash rates. We've seen this. So they need to raise interest rates. My successor, Thomas Jordan, has just given an interview over the weekend complaining rightly that the banks have not really adjusted the rates they pay on deposits in order to try to protect their profitability. So I think these changes in the structure of the capital markets, away from banking towards capital markets, mean that crises are going to be quite different. One space, if I were still in charge at the FSB, that I would watch is the entire kind of what's going to happen in terms of private credit lending from the capital markets. This is a whole new infrastructure. If you look at what's happening in many of the private market firms, they're connecting with insurance companies in order to have access to big balance sheets, in order to be able to lend to the private sector. In many ways, this can bring innovation, new forms of lending, but it also means the reaction when things go bad is going to be quite different. A bank knows its clients. It can deal with the clients. It has a history of the client's behavior. If you're lending out of capital markets, that's going to be a very different ballgame when things get tight. So I think this intermediation away from banking into capital markets is the space that I will watch most closely. The good news is, banks have done pretty well given the size of the shock. We've just seen the most aggressive interest rate hike in history, at least since the 70s. And, by and large, the banking system has been pretty robust. The cases where we've had crises were really management mistakes, business model mistakes, as opposed to anything systemic. That's the good news. I think where we have to watch what happens here as the system intermediates away from banking into capital markets, and this, of course, in a way is much harder to observe, it's harder to regulate. The entire BIS system, the entire regulatory system is still very focused on a banking-based model. And I think the question will be, what happens in a world where inflation is sticky, we're in for a kind of long-term structural bias towards tightening, and we've seen shifting away from banking into capital markets. How does the system behave in that kind of world when the inevitable stress points come, as was just mentioned?
Are stress points actually appearing in these capital markets at this point of time? I mentioned the dislocation in the treasury market. The participants are not really banks as such, and they're not really regulated. Where are the risks? Are risks lurking around that we are not aware of? Is the Financial Stability Board, sorry to say this, doing an adequate job? I'm born to be worried. I am worried, actually. What do you think from the perspective of, an institution, BlackRock, that is very much involved in many of these things?
I would say, again, I would watch two areas. One is what happens when private markets adjust their valuations to public markets in the aftermath of the interest rate, the very significant changes in interest rates. That process is not complete yet. Obviously, it also depends where public markets settle in this new environment. But I would say that is one space to watch. You know, what happens as holders of private market exposure inevitably have to begin to readjust or adjust their valuations. How do they react to that? Do they sell liquid equities in order to make up for that? Do they try to compensate elsewhere? And I think that's a process that's only just begun. The second one is the one I mentioned. You know, what happens to credit behavior as more and more credit provisioning happens in the capital markets and no longer just in the banking system? Can we, as this happens, can we fuel the economy sufficiently out of the capital markets? Now, many, particularly our US colleagues, will say that's a very good thing when that happens. It remains to be seen. In Europe, for instance, as you know, most corporates are still funded very much through the banking system. So how do we keep up a sufficient flow of credit when these changes occur away from the banking system into the capital markets? So I think there are places that we should look at very carefully. But again, on the whole, I'm encouraged by the way the system has, in a sense, been resilient, at least so far, in light of this very extreme change in interest rates that we've seen. I think if all of us had been asked a year ago what happens when rates go from 0 to 5%, we probably would have said a lot more than what we've actually observed so far.
Yes, I think I agree with you. But I tend to worry too much anyway. So let me turn to Phil. Looking at Australia from Hong Kong, I think the RBA has been very successful in, at the same time, curbing inflation and maintaining financial stability. Although inflation now is still negative, I mean, the real interest rates are still negative anyway. You seem to have struck a right balance between, ensuring price stability and financial stability. Now, on the other hand, at the same time, I've just learned from the news that the Australian government is changing the mandate of the RBA. I mean, such a successful institution, and why are you put into such a situation? Although you have just retired, that's why I asked you, because you'll be freer to talk about these things.
Well, there's no kind of fundamental shift in the mandate here. The mandate of the RBA has always been price stability, full employment, and the general welfare of the Australian people. And under the legislative changes that the government's proposing, that's still going to be the case, although there'll be some kind of rewording. But fundamentally, the central bank will still have a dual mandate, which is appropriate. Perhaps I can just return to some of the other issues that we've discussed. I think the coming years are going to be much more difficult than the previous years, and I think we're going to see a lot more variability in inflation than we've had for the last 30 years. Over the past 30 years, we all got used to the idea that central banks could control inflation within a very narrow range. I remember being in trouble in the press and with the politicians for missing the inflation target by 0.5%. I always felt like it lacked perspective. I think going forward, we're going to see a lot more variation in inflation. Philip touched on some of the reasons. More supply shocks, climate change, the adjustments in our energy system, geopolitics, and demographics. All those things mean that we're going to be hitting the steep part of the supply curve more often, or the supply curves are going to be moving around, and inflation's going to be more volatile. And we're going to have to get used to that. And this is why I think the current inflation test is so important, and it's so important we pass it. This is the first example of this more volatile inflation world. Many countries' inflation went to 10% or close to it. 5 years ago, people would have thought that was completely crazy, but it happened. And I don't think we're going to see 10% very often, but we're going to see more variability in inflation. Many countries now are saying that inflation won't get back to target until the end of 2025. That'll be 4 years of inflation above target. the cumulative deviation, the price level of those 4 years is very large. And if we push, or if central banks allow that timeline to be pushed out even further into 26, I think the community will rightly say, are they serious? And that'll be a problem if they do. So I think the central banks have to be able to convince people that inflation will return to target fairly soon. If they don't, then the next time inflation is going to be moved away from target, and there'll be plenty of examples of it, that people won't believe that it'll come back, and that'll make the lives much harder. So I hope that most central banks have done enough, but I'm worried that they haven't, and it's doubly important that we pass this first inflation test. I still see plenty of upside risks to inflation. Labour markets are still pretty resilient. Unit labour cost growth in many countries is not consistent with the inflation target, partly because of weak productivity growth. So the wage system has to adjust to weaker productivity growth. It doesn't. If it doesn't, that means more inflation. And populations have become very upset at the cost of living pressures. I'm seeing in a lot of countries, governments say, well, that's very difficult, and let me help you out. That tends to add to inflation as well. So there's still plenty of risk, but it's doubly important that no matter what mandate you have, that we pass this inflation test. The first test of this war where inflation moves around a lot more than kind of 0.5 to 1%, which is what we used to worry about. Now we're worrying about 3 or 4% movements. Thank you.
Thank you very much. I think on price stability and financial stability, we can carry on. I mean, there's so much to discuss. But I would like actually to tackle another issue, which may be of interest to our audience and to the panel, before opening it up for question and answers. And that is to do with geopolitics and the global financial system, particularly the international monetary system. Jacob, where are we heading there? I mean, there's been a bit of rollback of globalization in terms of trade, but in finance as well. There were comments about, particular jurisdictions being uninvestable. There were reshoring of listings of one sort or another. There's this rollback that is that geopolitics has caused, and at the same time, I can say this because 20 years ago I started the internationalization of the renminbi. It's gone slower than I had hoped, but it is going to be a significant currency, playing a significant role in the international monetary system. And also last night, we heard from Zhou Xiaochuan, Governor Zhao, mentioning the SDR 2 or 3 times, and also introduce a term called synthetic currency for the world as a whole, to serve as the medium of international transaction, international exchange, and international store of wealth. Are we heading in that direction, Jakob?
Well, that's a very, very big question, indeed. It has to do with the interrelationships between markets. It has to do with spillovers. It has to do with externalities, and it has to do with the fact that the political jurisdiction of government differs from the domain over which those governments' policies have an impact on. So there was a time when we said that when the US sneezes, Europe catches pneumonia, and how do we ensure that there is a system? This was the raison d'etre for the international policy coordination framework that was introduced in the 70s or in the 80s. But I want to remind you that there were a lot of analytical issues that were involved in this discussion. The first exercise of coordination in 1985, the so-called Plaza Accord, focused only on the exchange rates. And the G5 was sitting around the table, and by the way, only ministries of finance, no central bank governors, were sitting around the table and deciding what should be the exchange rate. And this was the only topic. And the exchange rate was the jurisdiction of treasuries. And basically, that's all. And it was a great success. It was so much of a success that the appetite grew. And 2 years later, when they met at the Louvre, they said, why don't we coordinate also fiscal and monetary policies? Just to find out that it is much easier to discuss than to implement, because fiscal policies are carried out at home, and its implications are felt abroad. So how do you go about it? So they said, in such a case, let's try more. And they decided, let's coordinate also trade policies. And then, of course, they fell on their face, and they realized that it's not going to work, because politicians and governments are elected at home. This brought to the deep debate between especially the Germans and the French about semantics, which is full of content. Namely, should we call it international policy coordination, which is the French approach? They want to coordinate everything. You go first, I go first. Or should we call it international policy cooperation, which is the German approach? And cooperation means I cannot tell you what to do, but I want to understand what you do. I want to understand your model, and you will understand my model, and then you can internalize it the way you want. Even stories were developed about it, and let me take 10 seconds for a light story. When two brothers used to drive, each one in his own car. And one of them, Sam, took his friend to the ride. And when they arrived to the stop sign, there was a red light, and Sam crossed the red line. And the friend asked him, why are you crossing? It's red. He says, well, you know, my brother may come from the other side. All right, they came, then they arrived to the green light. And he stopped. Why don't you go on? Because my brother may come from the other side. And the lesson is, you don't need all to drive according to the same rules, as long as you know what your brother does. And this is very key. So I think that by now, oh, this was a delayed reaction. I think the interpreters had its own pace. You see, there are legs, and monetary policy has long and variable legs.
The international monetary system.
Yes.
Yeah.
So coming to the international monetary system, I think that mechanisms like the BIS, and I must say, are working much better than the mechanisms impacting on policies. They're like, I don't want to speak about the UN, but I can speak about let's talk about the IMF even. Because, no, it's not a criticism, it's the reality. The reality is that you cannot, the IMF, and we were there, some of us, even in parts, positions of leadership, Article 4, which is the mechanism by which you convey other countries your assessment and how you should do, if the other countries are small, they will need to do what you tell them. If they are large, you cannot have an impact. And the US, nobody will tell it what to do with the budget deficit. But so the system is not a place where you provide instructions and the other follow, but rather where you create norms. The problems that have happened during the past decade is that these norms themselves are not agreed upon. With the collapse of the so-called Washington Consensus, the way in which professionals believe the model, the system works, there is no convergence anymore. The very fact that we have had a big debate about conventional and unconventional, when to exit, what will be the long-term implications, what's the role of central bank independence, all of that reflects fundamental disagreements, not only about how the world works, but also what is the role of the contract between citizens and its governments, who can say what to whom, and what's the effectiveness of it. It sounds like 30,000 feet, but I think it's really fundamental. Let me make one footnote to what Zeti said. It was very profound. when Zeti explained that the 2008, not global, but great financial crisis did not impact Asia in the same way as they impacted others, one of the reasons is that Asia was lucky to have had its crisis in 1997. And the lessons were drawn for increased resilience. And that's basically the point that Zeti was trying to make, and profoundly so. Thank you.
I really don't know how to interpret your answer to my very simple question as to the future of the international monetary system. Now, let me ask my other panel members, are we moving towards a multipolar system in which the dominance of the US dollar would fall, or even to a bifurcated framework where there are only two poles in that international monetary system? Or are we, like Governor suggested, likely to come up with a synthetic currency for use in the settlement of international transactions and the store of wealth? Philip?
Excuse me, just a footnote. No, seriously speaking, about the changing environment and why it's not so simple to answer your question. When we met first during the Asian crisis and shortly before, you were speaking about the prospects of creating an AMF, Asian Monetary Fund. Where is it now? So it's not that something failed, but circumstances changed so much that creating a rigid system around changing circumstances is a recipe for tension.
Okay, thank you. Philip?
Joseph, there's no doubt in my mind that we have a much more fragmented world. I think it's important to state this is not the end of globalization. If you look at trade flows, FDIs, or any other globalization indicator, you can see that basically globalization kind of plateaued in 2008, stayed more or less steady until Trump came, and since then there's been a kind of rewiring of globalization towards a more fragmented world. Does that lead to multiple reserve currencies, to a complete new monetary order? I think we're a long way from that, but as a general trend, this is where we're headed. It also looks, at least from today's perspective, these changes are pretty persistent, and they are, of course, one of what I would say the three major constraining factors on the global production capacity. Phil mentioned, all of this. This is what leads to more volatility on inflation. This is what leads to bigger trade-offs for central bankers. This is what leads to lower trend growth in terms of GDP. It's basically fragmentation, it's aging, and it's probably the climate transition. Now, I think, not to get too pessimistic here, this new system involves costs. One would hope that over time, this shift from sort of efficiency to resilience, which is what this is really all about, leads policymakers, politicians in particular, over time to reassess, is the added resilience worth the economic cost? And so one can hope that there is some recalibration in the system at some point. And maybe we've gone too far towards efficiency during the Great Moderation. But I would argue that there's a real risk that we go too far towards fragmentation, particularly when I think of Chinese-US relations. China has just seen for the first time negative FDI flows. How long do you keep up this kind of mutual pressure, and how much economic cost do you accept in return? If you look at the recent summit in San Francisco, perhaps that gives you some hope that this trade-off is beginning to be recognized, and perhaps we want to recalibrate a bit. So time will tell how far down this road we will go towards a fragmented world. One thing I'm sure about is these costs are not to be underappreciated. And again, it seems to me that at some point we're going to calibrate back the other way to make sure we don't sacrifice too much in terms of prosperity, efficiency, in order to have this sort of fragmented world that allows for a lot of protectionism. I think we're a long way away from a completely sort of fractured world with multiple reserve currencies.
Thank you very much. Phil, would you like to add a few
I
comments?
agree with very much what Philip was saying, but I'll just pose the question is, why is the US dollar still the dominant global currency? I think the answer is it's easy to transact in US dollars. People can buy and sell US dollars without restriction. The markets are deep and liquid. The transaction costs are low. The property rights are secure. And the hedging markets are deep and liquid. That's why the US dollar remains dominant. If other currencies can generate those same characteristics over time, then I think they can sit in parallel with the US dollars. But if they can't, then I think it's not likely that private markets will want to use other currencies in the same way that they want to use the US dollar. So property rights, deep and liquid markets, ability to transact without restrictions. If those things don't exist, then I think the markets are not going to develop, and the US dollar will retain its dominance. I think we'll be better off if other currencies have those characteristics, but that's not the situation we're in at the moment.
Shilagawa-san, any comment?
I have nothing to add to what Phil just said. But Joseph's question boils down to how central bank could improve the functioning of international monetary system. And in this respect, there are several dimensions. One is how central bank should act as a lender of last resort when crisis should come. And in this respect, I still vividly remember how central banks responded to the collapse of Lehman Brothers in the fall of 2008. And when crisis should come, what is most important is determined and shared will to save financial system. And in the area, what I'd like to emphasize in normal condition is the effort of central banks at improving payment and settlement system. And this is rather low-hanging fruit. And the central bank should make every effort like they are now doing. And in terms of monetary policy, Jacob said, I'm not a big fan of the policy coordination as such. I'm a fan of central bank cooperation, but especially the cooperation is needed given that the financial market is so much globalized. But cooperation is easier said than done. And but what we have to realistically hope for is informed discussion at finding enlightened self-interest. And I remember the BIS global meeting in Basel when I was a governor, and the chairman always said the almost 90% of world GDP is produced by members of global economic meeting. And so even though it is difficult to internalize spillover and spillback effect of key currency country, still informed discussion is quite important. So we cannot think of a magical solution to achieve ideal international monetary system. Yeah, that is my response.
Thank you very much, Gawa-san. Dr. Sethi, would you like to add anything?
These changes in configuration of how it will turn out in the international monetary system will take years. And for the emerging world, we have to take it as a given. And that is why I go back to the point that the important thing for us is to build our resilience. So, and also our agility, which means economic flexibility, which it is to our advantage in the emerging world, because very often in the developed world, they are matured economies, and therefore it's more rigid. They don't have the flexibility to adjust. Whereas for the emerging world, we have that element and ability to adjust to changing conditions, whether it's productivity, innovation, and all the other that the panel has mentioned. And because of that and our relative resilience, we have the potential to survive it.
Thank you very much. Now, we're running out of time, and I think we should have time for questions from the floor. Anybody would like to ask a question of this panel? Please. Oh, Hans Gamberg.
Thank you. Central banks are asked to do more and more things. For instance, dealing with climate risk, dealing with inequality, and perhaps many other things that are not sort of core mandates. Is that a threat to independence, or do central banks have to take on these additional items in order to remain relevant and therefore gain independence from the political authorities?
Who would like to take that question?
Hans, maybe this is slightly provocative, but I would say perhaps some of this was a result of, again, this great moderation period where the main objective came almost automatically. And it's not surprising to me that as you saw the inflation challenge suddenly hitting back, both in terms of this immediate spike, but also in terms of some of the longer term challenges that Phil mentioned, there does seem to be a kind of refocusing on the core mandate. And I think that's a healthy kind of correction, especially if you're right or if we're both right. And this remains kind of a persistent challenge to keep, inflation expectation anchored. Then you really want to focus your main efforts on your main mandate. And I suspect, that's what we're seeing at the moment, a sort of refocusing on the key issues that really central banks are tasked to achieve.
Oh, Phil, and then Jacob. Phil first.
I mean, central banks have a really hard job. I think it's going to be hard to maintain price stability. It's hard to have maximum employment, and financial stability is hard. I don't think they need extra objectives, including climate change and income inequality. And I worry that if we take on those extra things, then it diverts our attention and actually will bring ultimately more political criticism, because we can't do very much about climate change in the end. And in the end, we can't do very much on a sustainable basis about income inequality. So I think let's stick to our core mandates: price stability, financial stability, and full employment. That's big enough job.
Thank you. Jacob, and then Shiragawa.
The criterion should be, don't take responsibility for things that you cannot affect. Simple like that. So the criterion is not, let me take over as a good citizen with the thinking broadly for the country, what are the important challenges for the country? Because if you cannot really contribute significantly, primarily, to this objective, you will be held responsible without having the ability to do so. So I think it is, it sounds like bureaucratic, but you cannot kill more than 3 birds with 1 bullet.
Shiragawa.
Yeah, I believe central bank should focus on core mandate of price stability and financial stability. And we should reflect on why central banks are now being called on to contribute to do many things. And that is partly related to the central bank's activism itself. Up until global financial crisis, the size of central bank balance sheet to GDP is quite small. And now the size of central bank balance sheet is so huge. Given this huge size, of course, it is quite natural how central bank should behave in portfolio affect the resource allocation. And the same is true for prolonged monetary easing. If monetary easing is prolonged, then its effect on income and the wealth distribution is huge. It therefore interferes with the income the distribution issue. So In a sense, the call for central bank to do many things is partly the own making of central bank. So we have to think about whether or not central bank activism on the part of monetary policy is really good from long-run perspective. That is my response.
Thank you very much. I think that more and more responsibilities are being put onto the central banks from the politicians, simply because the central banks have performed actually quite well over the past 30 years or so, handling the two financial crises, and governments have not been able to handle these issues themselves on the fiscal side. And if there are political brownies that can be gained from, tackling climate and inequality, and if there is an institution over there that can actually help deliver these objectives, then political pressure would be put onto the central bank. But I agree with the panel that we, as central bankers, should resist this. We should focus on our core mandates. Seti, have you got anything to add?
Yes, you have summed it up, Joseph, exactly. And yes, we should focus on our core mandates, but from time to time, if we are called upon to deal with certain areas and issues, it can be done, but there has to be very great clarity in the outcomes that are supposed to be achieved so that the accountability for it is there, and then the governance arrangements, and then the exit from it. In other words, a boundary management by the central bank in this whole process, so that we are not seen to be oblivious of everything that's happening, and just because we have to focus on our core mandate. And especially this is true in the emerging economy central banks, because all the best talents are really with them. And so this is the reason for it. Yes.
Thank you very much. We're overrun by about 5 minutes. I don't want to, summarize or whatever, except, of course, asking everybody to give a warm applause to our distinguished panel. Thank you very much.
Thank you very much to Joseph Yam and all our panelists. Can I ask you all to come to the front, squeeze in, because there are 6 of you, for a group photo. We'll have a photo from our official photographer and then one for our media photographers. Media photographers at the back. Great, thank you so much.